So let's talk about Dogecoin. You've probably seen the headlines, the meme, the hype, and the incredible rallies where Dogecoin suddenly shoots up in value overnight. And I get it, it looks tempting. But before jumping in, we need to step back and ask ourselves, is this really an investment, or is it just speculation dressed up as one? The truth is, Dogecoin started as a joke. It was never designed to be a serious financial instrument. Yet, through social media, celebrity endorsements, and sheer internet momentum, it managed to grow into one of the most recognizable cryptocurrencies in the world. But here's the catch: recognition doesn't always equal value. An investment is something backed by fundamentals, something that can provide sustainable returns over time. With Dogecoin, what you're really betting on is people's attention, and that can vanish quickly. Now, let's address risk. Dogecoin is one of the most volatile assets out there. It's not unusual to see price swings of 20%, 30%, even 50% within days. For some, that volatility feels like opportunity. But for most investors, investment, it's a recipe for emotional decision making. Buying at the peak, panic, selling at the bottom, and walking away with losses. Unlike real estate, stocks, or even Bitcoin to some extent, Dogecoin doesn't have a strong track record of building steady long-term wealth. Then comes the question of utility. What problem does Dogecoin actually solve? Bitcoin positions itself as digital gold. Ethereum powers decentralized applications. Stablecoins provide a bridge between fiat and crypto. Dogecoin, it's mostly known as a tipping currency online, but its use cases beyond that are limited. Everything meaningful adoption or innovation, its long-term sustainability is questionable. Finally, let's talk portfolio strategy. Should you avoid Dogecoin entirely? Not necessarily. If you see it as entertainment, as a fun side bet with money you're willing to lose, it can fit into your portfolio, but only as a very small percentage. Think of it as going to Vegas. You wouldn't take your retirement savings and put them all on red, but maybe you'd gamble a small amount for the thrill, knowing full well you could lose it. That's how Dogecoin should be approached, never as the foundation of your financial future. So, should you really invest in Dogecoin? The answer depends on your expectations. If you're chasing quick reaches, you might get lucky, but you're just as likely to get burned if you're building wealth long term. Focus on assets with real utility, strong fundamentals, and proven performance. Dogecoin may be exciting, but excitement is not a strategy. When it comes to Dogecoin, the first thing that has to be made clear is the difference between speculation and investment. Most people confuse the two, investment, and that confusion can cost them a lot of money. An investment is when you put your money into something that has long-term value, a track record, and the ability to generate returns in a predictable way. Investment. Think of stocks and companies that have earnings, pay dividends, or own valuable assets. Real estate that produces rental income is also a good example. Investment. These things have intrinsic qualities that make them valuable regardless of hype. Speculation, on the other hand, is more like a bet. You're not putting money into something because it has solid fundamentals, good investment, but because you believe that someone else will be willing to pay more for it tomorrow than you did today. That's the essence of gambling. It's dependent not on the asset itself, but on crowd psychology. Dogecoin falls much closer to the speculation side of this spectrum. It was created as a joke with no real innovation behind it. Investment. The reason people buy it is rarely because they believe in the underlying technology or its utility in the financial system, but because they hope its price will go up, often driven by hype on social media or celebrity mentions. That doesn't mean no one has made money with it. Of course, some people have, but the way they made money wasn't through the asset producing value. Investment. It was through timing the market, and that's a very difficult game to play consistently. The danger comes when people start treating speculation as if it were investment. Everything makes a good investment. They hear stories of someone turning a few $100s into thousands overnight, and they think that's replicable and sustainable. What often gets left out is the countless people who bought late, held on too long, and watched their savings evaporate in a crash. If you approach Dogecoin like an investment, expecting steady returns or long-term security, you're setting yourself up for disappointment. The reality is, and speculation can have a place in your financial life, but only when it's treated as speculation. If you put in a small amount of money that you're fully prepared to lose, it can be an exciting gamble. But mistaking Dogecoin for a genuine long-term investment is where most people go wrong. Knowing this distinction is the first step in protecting yourself financially. When we look at Dogecoin, One of the first realities that hits us is just how volatile it really is. Volatility means price swings, sometimes extreme ones, that can happen within hours or even minutes. For some people, that's the thrill. They see Dogecoin jump 20% in a single day and imagine the quick profits they could make. But the flip side is just as brutal. The same Dogecoin that soared 20% one week can drop 30% the next, wiping out gains and leaving investors stuck with heavy losses. This level of unpredictability makes it very difficult for the average person to hold on to their investment without making emotional decisions. Unlike traditional investments like stocks or bonds, where value is often tied to earnings, assets, or interest payments, Dogecoin doesn't have fundamentals to anchor its price. Its value is driven almost entirely by sentiment, what people feel about it in the moment. When enthusiasm is high, prices skyrocket. When that enthusiasm fades, the bottom falls out. Investment. That kind of environment is more similar to a casino than to a structured market. And while a lucky few walk away with winnings, investment, the majority end up losing because they bought during the excitement and sold during the panic. This volatility can also be deceptive. Investment. It's easy to look back at past rallies and convince yourself that you could have gotten in early and made a fortune. But in reality, timing those moves is nearly impossible. By the time most people hear about a price surge, it's already too late. They buy at the top, and then the inevitable correction drags the price back down. But those who bought on hype quickly learn that chasing momentum rarely leads to lasting wealth. On top of that, Dogecoin's inflationary nature adds another layer of risk. Unlike Bitcoin, which has a limited supply, Dogecoin is designed to produce more coins indefinitely. That means even if demand stays steady, new supply is constantly entering the market, putting downward pressure on prices over time. Combine that with wild price swings, and you have an asset that's incredibly difficult to predict or rely on. For the disciplined investor, investment volatility isn't always bad. It can create opportunities if approached carefully. But when the entire value of an asset depends on unpredictable enthusiasm, the risk becomes disproportionately high. Investment. Dogecoin may give you the ride of your life, but that ride is often more like a roller coaster than a path to financial security. Knowing this risk is crucial before putting any serious money on the line. When evaluating Dogecoin, one of the most important things to ask is whether it actually has real utility or strong fundamentals that justify investing in it. Every sustainable investment, whether it's a company's stock, investment, real estate, or even other cryptocurrencies, is usually backed by some kind of purpose or value creation. A company sells products or services and generates revenue. Real estate produces rent and appreciates with demand. Even Bitcoin is often referred to as digital gold because of its scarcity and decentralized nature. Ethereum has become the backbone of decentralized applications, powering everything from smart contracts to decentralized finance. These are fundamental reasons why people invest in them. Dogecoin, however, doesn't really offer that same foundation. It was created as a joke in 2013, meant to parody the speculative frenzy happening in the crypto space at the time. The code itself is almost identical to other cryptocurrencies, and it doesn't bring any major innovation. For most of its history, Dogecoin was used casually as a tipping currency on social media platforms. People would send small amounts of it to each other as a fun way to say thanks. While that might sound interesting, it's hardly the type of utility that can support long-term adoption or mass-scale usage. In terms of fundamentals, Dogecoin lacks many of the characteristics that make an asset resilient. Investment, it doesn't have a capped supply like Bitcoin, meaning new coins are being produced endlessly. That inflationary model makes it hard to treat Dogecoin as a store of value investment, since scarcity is one of the key elements that usually drives long-term demand in financial assets. Without scarcity, value is heavily dependent on constant interest and hype. Now, there have been moments when Dogecoin gained temporary legitimacy. For example, when high-profile figures mentioned it or when certain businesses briefly accepted it as payment. But those instances often came and went without lasting impact. Adoption remains minimal compared to other cryptocurrencies that are actively working to solve real-world problems. For long-term investors, this lack of utility and fundamentals is a red flag. If something doesn't solve a problem, doesn't create consistent demand, and doesn't offer protection against inflation or competition, but its value rests entirely on speculation. That doesn't mean you can't make money with Dogecoin. It simply means the money you make depends more on hype cycles than on genuine financial strength. without strong fundamentals, it's incredibly risky to treat Dogecoin as anything more than a short-term gamble. When considering Dogecoin, the real question is not just whether it can make money, but how it fits into your overall portfolio. A well-balanced financial strategy is about diversification, stability, and aligning investments with your long-term goals. That's where Dogecoin poses a challenge. Investment. If you treat it as a major part of your portfolio, you're essentially relying on speculation to build your wealth, and that's a fragile foundation. On the other hand, if you treat it as a very small allocation, it can function more like an experiment or even a form of entertainment without jeopardizing your financial future. Portfolio balance is about spreading risk. If you're investing in stocks, bonds, real estate investment, or even more established cryptocurrencies, you're diversifying across different asset classes with varying levels of risk and return. Dogecoin falls into the high risk, high volatility category. And that means it should never dominate your portfolio. Imagine putting half of your net worth into Dogecoin. Your financial stability would rise and fall with internet trends, tweets, and sudden market swings. That's not investing, that's gambling. A better approach is to think of Dogecoin the way you'd think about setting aside money for a weekend in Las Vegas. You go in knowing you might lose it all, and you're okay with that. If you make money, great, it's a bonus. If you don't, it doesn't harm your long-term financial health. Limiting Dogecoin to a small percentage, say 1% or less of your portfolio, allows you to participate in the fun while keeping the bulk of your wealth anchored in assets with stronger fundamentals. Another aspect of balance is time horizon. Long-term investments are supposed to grow steadily over years or decades. Dogecoin doesn't have that kind of track record, and its future utility is uncertain. So if you want to build wealth that supports retirement, pays for a home, or funds your children's education, putting too much into Dogecoin would be reckless. Those goals require assets with durability and resilience. Ultimately, a strong portfolio is like a sturdy house. It needs a solid foundation. That foundation comes from assets with proven stability. Dogecoin, while exciting, is more like a flashy decoration. It might look fun for a while, but you wouldn't want your entire house built on it. The smart move is to enjoy it in moderation while keeping your financial security intact through balanced, thoughtful investing.